I mean, you can simply say the silver inventories are extremely thin, and the pressure is accelerating. It'll be much greater if China and potentially the U.S. curtail exports. You know, part of naming silver a strategic element is that the U.S. can now very easily, the president can restrict and curtail exports. And this sets the stage for a potentially explosive reaction if demand or the systemic stress accelerates. What is the systemic stress? It's if one of these banks in London has a failure to deliver. And it's not just the silver market. You know, these banks are connected to everything financial. And so you would expect to see a contagion, a systemic reaction through reverberating through all markets. But yeah, I mean, the truth of the matter is London has been exposed as far as I'm concerned. And they're hanging on by a thread.
Something big is happening beneath the surface of the silver market, and it's not being driven by small investors or industrial demand. Andy Schectman says India has quietly become one of the largest accumulators of silver in the world, buying an estimated 600 to 800 million ounces over the past few years. That's a staggering amount for a single country. At the same time, Russia has announced plans to add silver to its strategic reserves, making it one of the first nations to treat the metal as a state-level asset rather than just an industrial commodity. Schectman points out that this isn't an isolated trend. Huge withdrawals from both the COMEX and LBMA show physical silver being drained from Western vaults, even as paper contracts keep trading in multiples of what's actually available. It's a clear sign that someone, most likely governments and large institutions, is taking real metal off the table. He says this shift is part of a broader movement among non-Western nations to secure not just gold and silver, but all key resources. The old saying used to be, whoever has the gold makes the rules. Now, it's evolving into, whoever controls the resources sets the rules. As for the United States, Schectman believes the recent surge in silver imports has little to do with tariffs, despite official claims. Insiders likely saw what was coming, the reclassification of silver as a critical mineral, and moved fast to bring it home before new restrictions took effect. In his view, the race for real assets has already begun, and the smartest players are no longer waiting for confirmation, they're acting. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
We know that India has been a massive player in the silver market. You can find quotes that it's purchased between 600, 700, 800 million ounces in the last 5 or 6 years. Copious amounts. We know that Russia said we're going to add it to our strategic stockpile, being one of the first countries ever to say that. We see massive deliveries. Talk to David Jensen on the COMEX, the LBMA numbers. Huge deliveries coming off the LBMA in a hugely rehypothecated market where way more contracts exist than bars standing behind it. To your point, we saw Saudi Arabia jump in, and I think it bummed a lot of people out that they bought SLV, but the amount that they bought in SLV allows them to actually stand for delivery. I think there are a lot more countries that have been doing this just on the down low than we are led to believe. You look at China as the second largest producer in the world, flying all around South America, going directly to the miners. Sean Kunkun has talked about this, CEO Dolly Varden, where they go right to the miners, disintermediating the marketplace, buying doré and concentrate right from the miners, paying double what the West will, and sending it back to China to refine it. They control the majority of all the metal refining and rare earth refining, so they just put it on a barge and send it on back to China. But it's coming from the second largest producer in the world. So that should put a little bit of context into it. If they're making that much or producing that much, why fly all the way to South America to pay double what the West will to buy doré and concentrate and send it back for refining? I think you will see that. I think it's been there under the surface if you really dig. But I think a lot of countries, especially those in the BRICS, have understood that silver and gold, this is a race for the world's commodities. And it's not just the precious metals, it's the base metals, it's the soft commodities. He or she who has the gold makes the rules, is how it used to be. How about he or she who has all the world's commodities makes the rules in the coming future? And I think that's what you're seeing. So Yes, I do think you'll see more countries and sovereign wealth funds probably at some point it'll be more transparent what they're doing. But in a world where information travels so quickly, it doesn't behoove any of these players to let anyone know just how much silver they're gathering. And then look at the US. I mean, I don't care what anyone says. It ain't about tariffs. I've been saying that for a year now. It is not about tariffs. It is not about arbitrage. Sure, there's a little bit of that truth, but it's being reshored. And, I've been screaming this. Look, all this silver coming into the country can't just be about tariffs. That was the ruse to get it all back here. Some of it's flowed back to ease the burden at the LBMA. But what it really is the smart money trading ahead of the news. Like, they knew that this was going to happen. They knew that it was going to be reclassified a critical mineral. So what do? They reshore it. They say it's tariffs so that London releases it and Switzerland sends it. Oh, by the way, it's reclassified. I mean, everything that at that level that they do, you look at all the massive gold accumulation in 2016, 17, 18, and 19, and then the Basel III reclassification of gold. These things that at the highest level, information is worth more than anything. And the people accumulating it, the central banks, the sovereign wealth funds, they're not just the most well-funded. More importantly, Jess, they're the most well-informed. And I think that's really what you would expect to see, the inside money moving first. And I think we're transitioning to that point where it's now out in the open, at least more so than it's ever been. And at that point, it's anonymity be damned. It's everyone rush to secure what they can while they can. So, yeah, I think you will see that.
Andy Schectman warns that the silver market is far more fragile than most people realize. If either China or the United States decides to restrict silver exports, a real possibility now that the metal has been labeled a critical mineral in the US, the global supply chain could tighten almost overnight. Such a move would hit industrial demand hard, especially for sectors like solar, electronics, and defense, where silver is irreplaceable. More importantly, it would expose just how little physical metal actually exists to meet all the paper claims traded daily. Schectman says the real threat isn't just scarcity, it's the system itself. London's bullion market operates on layers of leverage, with a mountain of paper contracts backed by a fraction of real silver. If even one major bullion bank were to fail to deliver on its obligations, that default could spread rapidly through other markets. These institutions are tied into global finance through derivatives and liquidity agreements, meaning one crack could destabilize the entire structure. In his view, the imbalance has reached a breaking point. The paper market is so oversized relative to available metal that the question is no longer whether something breaks, it's when. And when it does, silver's real price will reveal itself. Let's get back to the interview.
It's very true. David Jensen does a masterful job of showing that. But in essence, they're trading, 700 or 800 million ounces a day in London. 2 billion a day if you add the COMEX and the Shanghai market. But in London, 700 or 800 billion ounces a day with a float of 150 million ounces. What could possibly go wrong? And so, yes, they are. And I mean, you can simply say the silver inventories are extremely thin, and the pressure is accelerating. It'll be much greater if China and potentially the U.S. curtail exports. Part of naming silver a strategic element is that the U.S. can now very easily, the president can restrict and curtail exports. And this sets the stage for a potentially explosive reaction if demand or the systemic stress accelerates. What is the systemic stress? It's if one of these banks in London has a failure to deliver. And it's not just the silver market. These banks are connected to everything financial. And so you would expect to see a contagion, a systemic reaction reverberating through all markets. But yeah, I mean, the truth of the matter is London has been exposed as far as I'm concerned. And they're hanging on by a thread. There's exponentially more demand than there is supply, and there's exponentially more contracts than there are bars. That is a powder keg waiting to happen. In my career, almost 36 years, I've never seen Wall Street or Main Street acquiesce to anything other than 5% of gold, of an asset, a portfolio rather, being in gold. And and it was acquiescing at best. Fine, put 5% of your money in gold. Now, recently we've seen the chief investment officer of Morgan Stanley say, no, sell half your bonds and buy gold. Their new platform, according to him, is 60 stock, 20 bond, 20 gold. You got Michael Hartnett, the chief analyst for Bank of America, with this very, very, very expensive newsletter that goes directly to the institutional traders, like many thousands of dollars a year. He's saying, no, it's 25, 25, 25, 25, 25 gold, stock, bond, short-term treasuries, gold. You got Jeffrey Gundlach, the bond king, saying, no, 66, what did he say? Jeffrey Gundlach said, 25% in gold, Monday morning, 25% in gold is not overweight. And then the 6,600 part, that's Jeffries. They used to be a primary distributor for all the world's mints. And they said 6,600 is their next target, at least intermediary target, for where they expect gold to go before it takes a little bit of a breather. You have massive institutional money, traders and analysts and chief investment officers speaking to the most sophisticated traders in North America, saying 25% of your portfolio in gold is not too much. I mean, that's just insanity, if you ask me. Goldman Sachs said, if 5% of the money comes out of the bond market because they fear that there is no independence on the Fed anymore, that gold would go to 5,000 like that. Well, when you have Stephen Mirren sitting in the Fed, who it was Trump's advisor and the architect of the Mar-a-Lago Accord, he fills the vacated spot. What independence? The Fed has no independence. So gold is moving in that direction. You got Bank of America just saying $67 for silver is their target for next year. So when we talk about record highs around 4,400 gold and then it falling off and everyone's saying it's over, I find it disingenuous at best when you have these analysts saying this. And here we are back up above $4,100, and that shows the strength and the underlying support. So gold's held up because of central bank accumulation. And to me, that's what we've been saying forever. We've seen physical demand rising and global monetary stress increasing, all of the stuff that we talk about. But what I believe we are seeing, kind of what we were just talking about, is a slow motion global run on physical gold. And the pullback from those highs wasn't a breakdown, it was a consolidation, catching its breath, not throwing in the towel. Pick your euphemism. But the bottom line is gold isn't just strong, it's structurally more attractive than many people realize. And I think that the recent pause is the calm before the next leg higher. That I do believe. And maybe this is it here today as we're up over $100 as we're talking.
A quiet race for silver is unfolding behind the scenes, and it's starting to look less like normal market behavior and more like a strategic reshuffling of power. Major nations are no longer treating silver as a byproduct of industry, they're treating it as a tool of sovereignty. When India absorbs nearly 1 billion ounces, Russia folds it into its national reserves, and Western vaults are steadily emptied, it signals a major pivot in how value is being defined. The West may still control the paper trade, but the East appears to be taking control of the metal itself. Each ounce pulled from circulation tightens the margin for error in a market already stretched by leverage and synthetic contracts. If one key player fails to deliver, the shock could ripple far beyond commodities, right into the financial system's core. What's unfolding isn't just a shift in ownership, it's a quiet rewriting of the global hierarchy of assets. As silver transitions from industrial input to strategic reserve, could it become the next battlefield in the struggle for economic dominance? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.